you will make me feel you are more than welcome to interrupt as well. Okay, I'm going to go ahead and share my screen. So thank you all for coming today. I am going to be discussing sort of some of my research and giving a broad overview, looking at one really fundamental source of financing for higher education in the United States, which is student loan debt. Okay. So sort of why should we be interested in student loans? Um, Student loans, as I mentioned, are a fundamental part of the US higher education system. I'm mostly going to be focusing on the US today, but some of the themes I'll draw out are also relevant in other countries like the United Kingdom and Australia. And in fact, student loans are even present in places where higher education is highly subsidized, like Sweden. So in the US and internationally, there's an abundance of research showing that there are large benefits of gaining a college degree, higher earnings, improvements in health for the current generation, next generation, increases in productivity for other employees in the firm you're working in. But despite these benefits in the US, just a little over half of all undergraduate students who start a degree program actually end up completing. Okay, so completion is a big issue, and those who do not complete don't see these benefits. If they see benefits at all, they are quite small relative to the benefits that accrue to those who earn a degree. Student loans are an essential source of funding for many students. And in fact, if we look at recent graduates, the majority of these students had to take out or had student loans that they took out while they were pursuing higher education. In recent years, there's been a concern about a student debt crisis. The number of borrowers with student loan debt now exceeds 44 million, and the total amount of outstanding debt is more than $1.5 trillion. It's the second largest source of household debt, second only to mortgage debt, and it's the only type of household debt that increased during the financial crisis. While other types of debt fell as credit markets contracted, student loan debt just continued to increase upwards. And finally, there's growing evidence that there's disproportionate effects of student loan debt, negative effects on particular groups of borrowers, in particular Black borrowers, conditional on having the same income, going to the same higher education institution. Black borrowers face worse repayment outcomes. They're more likely to default and they repay their loans at slower rates. And so there's concerns about sort of equity implications of the growing student loan debt. All of these factors have led to and contributed to ongoing policy discussions around student debt forgiveness. Okay, we've been seeing these discussions for over 5 years now. At the start of the current Biden administration, there were increased calls to take action to forgive student loan debt. Elizabeth Warren, a senator, was one of the key proponents here. And in fact, sort of these advocacy efforts ultimately led to an effort to forgive a substantial amount of this outstanding student loan debt, where the projections were that of these 44 or 43 million borrowers, almost half would have their debt totally erased. And many, many more would see their balances cut by $10,000 or $20,000. So this was a culmination of years and years and years of advocacy and support for broad-based student debt relief. However, this plan was never allowed to go into effect. It was challenged, and the challenge made its way up to the Supreme Court, where the Supreme Court ruled that it was not justified by the legislation that had been used to provide justification for the debt relief. And then by this point, nearly 26 million borrowers had submitted an application to apply for student debt relief. So, lots of advocacy, a really ambitious plan that was ultimately struck down by the Supreme Court. And yet the call for student debt relief continues. So the Department of Education, the Biden administration, has now moved on to Plan B, using a different rationale for student debt relief, but sort of pursuing a similar approach of forgiving a large amount of student loan debt. So this is an issue that has just dominated discussions of higher education policy in the US and will continue to do so for the foreseeable future. Okay. Before we talk about research and policy, however, I want to just sort of give the lay of the land of student loan debt and how that factors into household debt. So sort of how has student loan debt changed, and are these changes sort of very similar or different to other types of debt that households take on? So I'm going to talk about essentially two periods: what happened during the Great Recession and what has happened in recent years. This is a figure showing the aggregate amount of household debt since 2004, so the past 20 years. And the point that is highlighted here, where these two markers are, is sort of the right before the start of the financial crisis in the third quarter of 2008. This was sort of when most types of household debt peaked. Housing debt at almost 10 trillion, and then non-housing debt at over 2.5 trillion. Okay. And if we fast forward, it took over 10 years before housing debt got back to this previous level. So just thinking about sort of outstanding household debt as a proxy for individuals taking up mortgages, it took over 10 years for households to recover from the financial crisis. We can also look at this category of non-housing debt. So this is sort of that top row that I'm breaking out now into the different types of non-housing debt: student loans, credit card debt, auto loans, and then other types of debt. These are going to be installment loans and sort of other types of debt product. And if we look at sort of what was going on right before the start of the financial crisis, okay, we can see it's the composition of this other type of household debt. But when we fast forward to this same point, we can see that, well, it took over 10 years for housing debt to get back to the level it was at in 2008. Over the same time period, student loans increased by 920 billion, and car loans increased by 540 billion. So seeing really different trends here for what is happening in terms of borrowing to purchase a house versus borrowing to purchase a car or to attend higher education. And if we go to the very end of this series, these two types of debt have just continued to grow. There's sort of been no leveling out of the growth in student loan debt and auto loans. We can also look at where this increase in debt is coming from. Here I'm showing you by age. So each of these lines is showing relative to the 2008 peak, so right before the Great Recession, how much has debt in each of these categories changed for borrowers that are within these age ranges. So if we just look at this dark blue, these are borrowers that are 18 to 29 years old. Okay, we can follow sort of this series, and we can see that by 2016, these borrowers still have much less mortgage debt than borrowers in the same age group had at the sort of right before the Great Recession. Okay.
Lesley,
Versus,
we have our
yes.
first question. We have
Oh,
our first
please.
question. Tanya is asking, what is the split of private versus public institution higher education in the U.S., and does this problem occur because there are more private institutions who charge higher tuition fees?
Yeah, that's a great question. So the majority of students are attending public higher education institutions, but private nonprofit higher education institutions, while they serve a smaller slice of undergraduates, their prices on average are higher than for public institutions, and more students borrow. So if we think about sort of where the student loan debt is coming from, okay, it's sort of disproportionately coming from private institutions relative to the share of students at these schools. Great. So going back to looking at differences by age, so for the oldest borrowers, these are borrowers that are 60 years and older, indicated by this gray series. Following the Great Recession, all categories of debt increased for the oldest borrowers. Okay, we can see this because sort of the gray line at the end of the chart here is greater than 1, right? 1 is sort of exactly the level in 2008. But among the youngest borrowers, only student loan and auto loan debt increased. So we sort of have a change in the composition of who's taking out different types of debt, where younger borrowers are shifting away from mortgages and credit cards in favor of auto loans and even more student loan debt. We can
And
also
Lesley,
look,
another
yes,
question.
yes, please.
Another question. Sorry, I hope this is the time lapse isn't throwing you off either. Kimberly asked, are private school students more likely to complete their degree?
Yes, on average. So private, nonprofit, institutions tend to have higher completion rates than public institutions. That group of public institutions is both bachelor's degree granting or four-year institutions, as well as community colleges, which are two-year institutions that serve the joint role of providing 2 years of education that you can transfer to get a bachelor's degree at a four-year institution, and providing a variety of vocational and technical degrees and certificates. Other questions? Great.
Not presently.
So we can also look at what's happening based on the income levels of where borrowers are living. This is sort of a proxy for household income. So if you live in an area where average income is less than $40,000 a year, you're much more likely to be low income yourself than if you live in an area where average income is greater than $77,000 a year. Okay. And so we can look at this shift in how much people are borrowing and by these different categories of loans and by income level. Okay, so in lower income areas, we see more of a shift from mortgage and credit card debt to student loans. Okay, so younger individuals are taking on more student loan debt, less mortgage and credit card debt, and individuals and households in lower income areas are taking on more student loan debt. There's a reason for this, and it's because student loan debt is really different than mortgages, credit cards, auto loan debt. 90% or more of student loans come from the federal government. And unlike loans to buy a car or to buy a house, there's no rationing based on creditworthiness. So if you're going to college and you filled out an application for federal student aid and you're a US citizen or permanent resident, you can borrow. You can borrow student loans. It doesn't matter if you have a credit history or not. It doesn't matter what that credit history looks like. You can borrow, and you can borrow the same as your neighbor next door who maybe comes from a family that is much wealthier than your own. And so following the Great Recession, when all of these other types of credit tightened up and it was much harder to get credit cards, much harder to get a loan to purchase a house, student loans were not affected. In fact, in the years right around the Great Recession, the federal government increased how much student loan borrowers could take on. And so this really was sort of an escape hatch for individuals who maybe they would have used a credit card to pay for college, or their parents would have taken out a home equity loan. And now, after credit markets became much tighter, they instead turned to use student loans for this purpose. Okay. Turning now to what happens to borrowers. This is a complicated figure, but I'll walk you through it. Okay, this is showing one measure of payment difficulties, the percent of total outstanding student loan debt that is at least 90 days late. So a borrower hasn't made a payment on this debt for at least 3 months. And this is the point at which most debt, being this late on most debt, has implications for your credit score. So it makes it harder to access credit in the future. And in some cases, it may even make it harder for you to rent an apartment. A lot of times landlords do a credit check. Even some employers do a credit check. And so we can see sort of two types of debt here: the student loan debt, which is this red line, and then all the other types. And if you follow all of the other types, we can see during the financial crisis, borrowers were struggling more to make payments. There were more of this debt was not being paid. It was at least 3 months late. And then sort of as we go forward in time, outcomes improve. Okay, the unemployment rate goes down, people are better able to make their payments. The only exception here we see is student loan debt. And in fact, sort of the 90-day delinquency rate for student loan debt was just gradually increasing during the Great Recession, and then sort of remained very high until the start of COVID-19, in which all student loan payments were paused. So no one was delinquent because no one had to make payments on their student loans. Okay, this actually relates back to what I was talking about earlier, where credit isn't rationed. So even if you are unlikely to repay your student loan because of, sort of things that the credit agency would use to determine whether you could take out a mortgage or get a credit card, you still have access to student loans through the federal government. Okay. So what did we learn here? I know that was a lot of charts and a lot of data. So let me summarize it. If we think about the place of student loans in households' overall debt, and we look at total household debt, after adjusting for inflation, total household debt is about the same as it was right before the Great Recession at its peak. There's been a pretty slow recovery in mortgage debt, but when we look at auto loans, and in particular student loans, we've seen an increase. So sort of households are taking on more student loans, auto loans, whereas housing debt has been slow to get back to where it was. There's been a significant shift in who holds debt to older and more creditworthy borrowers, except in the case of student loans. And across all categories except student loans, borrowers are struggling less to make payments. Delinquencies are generally improving, reflecting the fact that the economy has improved and borrowers are better able to make these payments, except for student loans that have seen continued increases in repayment difficulties. And so there's been this important shift in borrowing by the youngest borrowers. So the youngest borrowers are sort of shifting into student loans, where we see more repayment difficulties as time marches on. Okay, so sort of this is the high level landscape of what some people are calling the student debt crisis. And the next topic I'm going to talk about is sort of trying to understand why student debt has in fact increased as much as it has. But I'll pause here and see if there are any questions.
I was going to say, Lesley, I have a couple questions and it seemed like a good time. I'm going to work backwards through three because the last one, it goes back to a topic you were addressing earlier. But
Yep.
Louis Berkowitz asked, do you think the rise in interest rates will coincide with an increase in student loan delinquencies at the same rate as other debts?
That's a really great question. So a lot of what I say when I talk about student loans is that student loans are just different. So unlike, you know, revolving debt, so sort of debt that you're taking on in real time and paying off, that may have adjustments to interest rates. Student loan interest rates are fixed when that loan is made. Okay, so if I have student loan debt today, it doesn't matter what the interest rate is today. What matters is what it was when I borrowed 10 years ago. The other thing about student loans is that interest rates are pegged to the 10-year Treasury note. So sort of this is a measure of overall interest rates effectively. And so when market interest rates go up, student loan interest rates go up. When market interest rates go down, student loan interest rates go down. So there's not sort of a deal to be had just purely on interest rates for individuals today looking at, should I take on a student loan? Should I take on debt from another source? Except for borrowers that have a poor credit history or no credit history, where likely they wouldn't be able to access that other type of debt at any interest rate. The other thing, which I'm not really going to have time to talk about today, is the way that borrowers repay student loans has really changed over this same time period. So more and more borrowers now are repaying their loans through what's called income-driven repayment, which is very different than how other types of debt is repaid. Under income-driven repayment, when your income goes up, your payments go up. When your income goes down, your payments go down. If your income falls below a certain level, your payments go to zero. And after 10 to 20 years of payments, all of your remaining debt is forgiven. And so for borrowers on one of these plans, the interest rate is effectively meaningless because your payments don't depend on your interest rate. They just depend on your income.
Had another question came through, a couple more. So the issue of delinquency with payment, do you think it occurs, this is from Tanya, that's the earlier question, is do you think it's because of the inability of the higher education institutions to prepare students for the workforce?
Yes, that is a great question, Tanya, and something I'll be returning to at the very end. So is it sort of student loan debt per se, or is it also something about the quality of the education or whether the borrower is able actually to complete their degree? And it's definitely going to be, a combination, but maybe even weighing more towards those other factors, the quality and degree completion.
And then as a good taper tying to that, dovetailing this, Manish asked, are the rates of delinquency the same for STEM degree holders and non-STEM degree holders? If they are different, are there any interesting insights about the difference, which seems to tie into what you're just mentioning about institution versus ability to pay?
Yep. So I think broadly, delinquency and default rates are falling with borrowers' income, which is not surprising to any of us. If you make more money, you're better able to service your student loans. So on average, STEM degree holders tend to earn more. And so sort of that relationship is going to be there through the difference in income between STEM degree holders and non-STEM degree holders. But differences by major for undergraduates are going to be smaller than differences for those who complete and those who don't. So really the dividing line is whether or not you graduate and maybe the school that you graduate from versus what your major was, at least in the case of bachelor's degrees.
And then the last question for now, Cameron had asked earlier, why are completion rates at private institutions higher than at public institutions?
Yes, also a very interesting, important question. So it's going to be a combination of the types of students these schools admit and the resources available to students. So sort of who's coming in and what the school does. Private nonprofit institutions tend to be more selective. They tend to admit students from higher income families who went to better funded high schools and are students who are more academically prepared. So sort of the students coming in are in a better position to succeed. On average, private nonprofit institutions also have more resources. They have greater endowments. They spend more per student. And if we think what happens within a school matters, which I think all of us do, then that's also going to translate into better outcomes. I'm not going to be able to tell you today. I don't think there's any research that really definitively answers this question, how much of it is just student selection versus what the school is doing. But it's definitely going to be a combination of the two. How are we doing on time, Blake? I realize I don't have a
Sure. Oh, we're at 5:30.
5:30. Perfect.
So
Okay. Okay. So why is student loan debt increased? The answers are going to be really simple, actually. First, more students are borrowing. Okay, this is just showing undergrad students, grad students at different points in time, the share of them who have student loans. So back in 1999, 2000, around 30% of all students borrowed, versus if we fast forward to today, about 40%, sorry, if we fast forward to 2015, 2016, about 40% of undergraduates and over 40% of graduate students are borrowing. I mentioned at the beginning that completers, about half of all completers borrow. This is across the board here. These are just students point in time. And so this is going to be a theme that I'll return to, which is kind of confusing, but more completers, a higher share of completers borrow than non-completers, okay? Which is counterintuitive, but it makes sense if you think about, if I only go to school for a year and drop out, I have less of a chance to take on student loans than if I go for 4 years or 6 years. Okay, so more students are borrowing, and those who borrow take on more debt. So this is showing inflation adjusted, the average amount of debt students take on, okay? Undergraduate debt actually hasn't increased that much. This is on an annual basis. If we look at undergrad completers, average debt is around $30,000, and it's grown a little bit, but not immensely. Graduate student debt has increased quite a bit. So, and you can see here that graduate students borrow more. The final sort of contributing factor is that fewer borrowers are paying down their loans. Okay, so this bar chart on the left-hand side is complicated, so let me walk you through it. Okay, this is measuring the share of all borrowers who completed or left school in a given cohort. So this far left orange bar is they completed in the 2006-07 academic year or 2007-08 academic year. So among all of those borrowers who left school in either of those years, how many, what share had paid down at least $1 of their principal if we look 3 years out? Okay, so what shares have made any progress in reducing their loan balance? If we look at this earlier cohort, over 50% of borrowers had made some progress, okay? But when we move forward in time, this share has fallen. And I don't have more recent data points, but it has continued to decline. So, this is sort of one way of measuring how borrowers are making progress and repaying their loans. It's a very blunt measure. It's the share that have made any progress at all, okay? But this is also pretty concerning because the changes in how quickly borrowers repay are not equally distributed by student race. Okay, so this figure on the right is again complicated, but I'll walk you through it. Okay, it's looking at borrowers who entered repayment in 2009. So they either graduated or they left school and they had to begin repaying their loans. And rather than looking at the percentage of borrowers who paid down $1 or more, this is saying, let's take your original loan balance and let's see how much it's increased or decreased. Okay, everything below 100, which is 100%, means the loan balance has decreased. Everything above 100 means the loan balance has increased. Okay, and this is on average. So among borrowers that started repaying in 2009, it took about 6 years, 5 or 6 years for white and Asian borrowers to make any progress repaying their loans on average, paying down their balance. Okay, but if we look all the way to, let's say, 2020, white borrowers had around 90% of their original balance left, so they paid down 10%. Asian borrowers had about 80%. We see a really different story for Black and Latino borrowers, where their balances on average continue to increase year after year. So this is sort of, when I talked about the beginning, concerns over disproportionate effects by race and concerns that sort of the costs of student loan debt aren't distributed equitably. This is one place where we start to see that. Okay, so this is sort of an accounting exercise, but total student loan debt is increasing because more students are borrowing. If they borrow more, and they're repaying at a slower rate. Let me pause here and see if there's any questions.
We don't have any new ones that have come in yet, but
Okay.
people may be typing at present, so I'd say you can keep moving if you wish.
Okay. So what does this mean for students? And this is where things get a little bit more complicated, right? If we're thinking about the student debt crisis as increases in student loans and student loan usage, borrowers who take on very small amounts of debt actually have the worst repayment outcomes. Okay? This figure is showing by the amount that a student borrowed. So this very far left bar is students who took $5,000 of student loan debt or less in total. This very far right bar are students who took on $100,000 of debt or more. Okay, and then we go forward 5 years after these borrowers have been in repayment for 5 years. And we look at the share of these borrowers who've ever run into severe payment difficulties or defaulted on their loans. Okay, this is essentially they went 9 months without making a payment or making a full payment. And we see something that looks kind of confusing, where low balance borrowers tend to default at the highest rate. And the highest balance borrowers tend to default at the lowest rate. Okay, why is this? Well, this goes back to the question of, is it debt or is it something about the type of school you go to and whether you complete? Individuals who went to school for a year and then dropped out, they're not going to be able to accumulate $100,000 of debt. They're not even going to be able to accumulate $10,000 of debt given how much you can borrow in a given year. There's limits on federal borrowing. So these borrowers at the far left are going to disproportionately be students who dropped out without gaining a degree. And even though they have pretty small amounts of debt, it's much harder for them to keep up with payments because they didn't get that return on their investment. They didn't complete the degree and get the corresponding increase in earnings that we know occurs on average for individuals who earn a bachelor's degree, for instance. Okay. And repayment outcomes are worse for non-completers. This is another way of looking at the story I just told you. So this figure is showing how much a borrower's loan balance changes on average looking 4 years after they entered repayment. It's another version of that figure where 100% was sort of no change. Below 100% was a reduction in balance, and above 100% was an increase. Here, however, it's flipped, okay? Where positive means you've made progress, and negative means you've gone backwards. You now owe more than you started with, okay? And so 4 years after entering repayment, borrowers who completed their degree, they've paid down on average 6% of their original balance. Borrowers who didn't complete now have a balance that's 6% higher. So sort of a very different story depending on whether borrower completed or not. We also can see sort of these differences emerge by type of institution. This is going back to the discussion we were having about differences in outcomes for students that went to public institutions versus nonprofit institutions. Okay, if we look in the middle here at completers, so these 2 red bars, students who complete a degree at a public 4-year or nonprofit four-year, so these are bachelor's degree completers, are making fairly substantial progress in repaying their loans. Okay, those who complete a degree in a four-year public institution have paid down 10% of their balance. Those who complete at a nonprofit have paid down 13%. We see that there's still this sort of negative effect for non-completers, okay, but it's smaller than what we saw in the previous slide. If we look at community colleges, so these are open access two-year public institutions, we see that completers have essentially made no progress in paying down their loans 4 years later, whereas non-completers are making sort of worse or further backward progress. Their balance is about 7% higher. The final category that we have here are for-profit colleges. So these are generally non-selective. They are a range of institutions from big online national chains like University of Phoenix and DeVry University to small mom and pops beauty schools, essentially. So it's a very diverse set of institutions. This is a sector that is known to tend to lead to poor outcomes. So worse earnings outcomes, worse student loan repayment outcomes, higher student loan debt than other non-selective institutions like community colleges. And in fact, we see that same sort of pattern here, where even for-profit college completers are actually moving backwards on repaying their loans. So their balances are 8% higher than when they first entered repayment. And non-completers have seen their balances grow by 14%. So here we've got sort of a more nuanced story where there's both a dimension of completion that matters, so whether you get a degree at all, and the type of school that you went to really matters for how much progress you make paying down your loans. Okay, let me pause here and see, I think some questions came in.
Yeah, we had two questions. One, if we went back a couple slides to the one where you had the cohort from 2009, it was delineated by race. It was on the right-hand side
Yep.
of the two-parter one. The question from Manish was, why was that 2009 cohort chosen? Is it similar for other cohorts?
So I think, so this is not a figure I made, but I think it was chosen so that borrowers could be followed for quite a long time. So you want to see how this evolves, because in general, you can see in these early years, on average, borrowers aren't making progress. This might be because they're on one of these income-driven repayment plans and their earnings are low when they first start their career, but as their earnings grow, they make progress. Or it could be that they're actually not keeping up with their payments and becoming delinquent and there's fees being added to their balance. So you need to go far enough back to be able to follow everyone for enough time that we get to see these patterns emerge. The earlier we look, if we have fewer years, the differences are much smaller than if we followed borrowers for 11 years here. If we look at cohorts surrounding 2009, patterns are going to look pretty similar. It's going to be hard to say for more recent borrowers just because there was a 2.5-year payment pause, so everyone's balance was staying exactly the same. The pandemic happened, and they haven't been in repayment long enough to really see, is this pattern still present? My guess is that sort of all of the factors that have contributed to these differences are largely still present. And so if we sort of give more recent borrowers enough time, these same patterns may emerge absent sort of broad-based student loan forgiveness, which obviously would compress this quite a bit.
And Hugo had a question, which was, is there a growing saturation in the market of people with degrees leading to underemployment, making it hard for those to climb the social ladder and repay their loans?
Yeah, so our sort of degrees being devalued because more and more people are completing. I don't think the evidence suggests that's the case. So if we look at any point in time, people with a college degree earn more, they're more likely to be employed. Even during sort of downturns, the Great Recession, that was still true. And so even as completion rates or the number of people with degrees has increased, there really hasn't been a noticeable decline in what's called the college wage premium, or how much more someone with a college degree earns relative to someone with only some college or with a high school degree. If you've taken sort of intermediate economics classes and are thinking, but shouldn't prices, wages go down when supply, number of workers goes up? There's lots of other things happening in the background. The sort of ability of people with a college degree to be productive has potentially been increasing with increases in technology. So this is what's called skill bias technological change. That as technology has increased, the sort of value of having a college degree has increased. And that has kept pace or even outstripped the increase in the number of people with college degrees. Interestingly, in recent years, college going has actually fallen relative to pre-pandemic. So fewer people are going to college, even if we look within a given age cohort. So fewer 18-year-olds are going to college than before the pandemic. Okay. So finally, I'm going to talk a little bit about my own research here. Okay, and here again, there's going to be some counterintuitive results. This is going to be really high level, and so please jump in and ask questions if you have any. Okay, so the question of the papers I'm going to talk about is basically, does access to student loans ever benefit students? Does this source of financing, which most students rely on, can it be beneficial? And at the end, I'll talk about sort of what this means, what these two things mean, sort of access to loans and beneficial. So most students attend open access public institutions, community colleges, and open access public four-year institutions. And in almost all of these schools, all students who meet these minimum requirements that fill out a federal student aid application, they have access to loans, and they have access to the same amount of loans. But there's discretion on the part of institutions in how students are informed of their loan options. So for students that are considering attending one of these schools, the school puts together what's called a financial aid package that lists out, here are your costs that you would expect to pay if you go to this school, and here are the types of financial aid that are available. So here are grants from the federal government, from state governments, maybe from the institution. And then the school has discretion over how it informs the student about loan options. Schools are required to let all students know about loans, but they don't have to put it in this financial aid award letter. Okay, so this sounds like a really nitty-gritty little thing that probably shouldn't matter. But in work with my co-author, Ben Marks, we worked with a anonymous community college, and now we're doing ongoing work with a public four-year institution. We worked with schools to randomly assign how students were informed of their loan options in this one award letter. This didn't change the process students had to go through to borrow. They still had to opt in to borrow and fill out another form. It didn't change the information students had. The school informed them of sort of the general loan eligibility requirements and how much they could borrow. It just changed essentially one number on this financial aid award letter. But in fact, this had outsized effects on borrowing. Okay, so students that had a loan listed in this one particular place in this award letter, okay, 32% of them borrowed, whereas students that didn't have a loan listed, only 23% of them borrowed. So this is a 40% increase in the probability of taking up a student loan due to one small change on this award letter. Okay, so this could be good, this could be bad, but in fact, this setting allows us to then ask, okay, for the students, that borrowed, because of this small change on their award letter, what happened to them? Okay. And in fact, we find that they on average benefited. They attempted more credits, they earned more credits, they had higher grade point averages. And if we look 1 year later, they were more likely to transfer to a bachelor's degree program. Okay. So we have sort of this, offsetting effects. These students have more debt, but we know completion is a big challenge, especially for students at these open access institutions. And having a small amount of additional debt appears to have allowed students to progress through their program quicker and maybe even transfer to get a higher, more valuable degree. One might ask, and in fact, we did ask, well, is this really just about the information students had? Maybe this number in this award letter is really students are taking it to mean, oh, I should borrow, I shouldn't borrow, or I have access to loans, I don't have access to loans. And so we ran a second experiment where we looked at students who had loan eligibility, but they hadn't borrowed yet. And we sent them emails basically giving them information about how student loans worked. The key piece of information in these emails was sort of the typical borrowing of past students. So among students who looked like you, who completed their degree last year, this is how much they borrowed on average. And all of these emails encourage students to make a decision, either to decline their student loan or to accept a student loan and indicate how much they wanted to borrow. Okay. Rather than this having an effect on students' active choices, what we found instead was when we provided this additional context of what past students had done, students were less likely to take any action. Okay, they were less likely to decline their loan, they were less likely to accept a loan. And this is consistent with sort of information overload. But this information, although it was intended to be helpful and provide context, was not in fact helpful and led students to be less likely to make any decision at all. Okay. So I think this is an ongoing research agenda where the goal of my co-author and I really is to try and understand how do you inform students about their loan options so that they can make the best decisions for their circumstances. So that students who actually would benefit, who would be able to take more classes, they can take on the loans that will help them do that. Whereas students who may be harmed or may not need that loan can avoid taking it on.
I
A
have one
second,
question that came up
yes, please.
for that, Lesley.
Yes.
Manish asked, is the loan take up in this intervention higher for lower income students? Is this effect across the board?
Yes, so that's a great question. We find a pretty similar effect by income level. We don't see substantial differences for the lowest income, middle income, or high income students. Trying to think. We see the biggest effect actually for students who had taken on loans in the past. And so for them, having a loan sort of listed has much bigger effects than for students who haven't borrowed in the past. One interpretation would be if you borrowed in the past, then maybe that's an indication that you needed this loan to be able to afford your classes. And so if you're nudged sort of out of borrowing, that could have bigger effects than if you're nudged into borrowing or continuing to borrow. Any other questions here? Okay, great. Okay, so continuing on this line of, can loan access ever benefit students? I'll talk about a second set of papers that instead of running an experiment, we use what's called a natural experiment, okay, that comes from changes in policy that affected different students in different ways. And in this case, the policy that we're studying is increases in federal student loan limits. As I mentioned, about 90% of all student loans are coming from the federal government. For undergraduates, that's going to be much higher, more like 95%. The private student loan market is quite small for undergraduates. My co-authors and I, we look at the only increase in annual borrowing limits for federal student loans in recent history. Okay. And these sort of increases hit different students at different points in time, leading different students to experience sort of smaller or larger increases in the total amount they could borrow. Okay. And then we follow these students, okay, those that got access to higher loan limits versus those that didn't. And we compare students who had basically maxed out their loans. So before limits went up, they had exhausted their eligibility. We compare them to students who had borrowed but hadn't exhausted their eligibility, with the idea being for that first group that we're calling credit constrained borrowers, when limits go up, some of them are going to borrow more, okay, because they are sort of borrowing right at the limit before these increases occur. We look at a variety of outcomes. The first one is student loan debt. And here on the right-hand side, I'm showing you sort of a summary of our results. This is showing the percentage change in the outcome for four-year entrants. So these are students that initially enrolled in a four-year college. Student loan debt went up by about 8% for this group. This is about $1,800 on average. Okay. But we also see improvements in persistence. We see increases in degree receipt, and in particular bachelor's degree receipt, and actually in STEM bachelor's degree receipt. And I think most interestingly, we're able to look at financial outcomes, and we see reductions in student loan delinquency and student loan default. Okay. So for these students that sort of through their behavior appear to really need additional student loans, it seems like access to that additional liquidity actually helps them make it through college and even sort of earn more in the long run. I'm not showing that here, but they earn about 4 to 5% more if we look 10 years after they entered college. We also get some indication of maybe why we see these effects. We see for these students, they're less likely, they have less credit card debt early on in their college career. And I think more importantly, they're less likely to be working and have lower in-school earnings. And so sort of the interpretation that we take here is that for these very constrained students, when they get access to additional financial aid, which happens to be in the form of loans, it allows them to substitute away from working while they're in school in favor of spending more time on their coursework, maybe taking more courses, maybe pursuing a degree that takes more time, like a STEM degree. As a result, they're more likely to graduate, they have higher earnings, and because of their higher earnings and better economic position, they're less likely to default on their loans. Interestingly, we can look at sort of other financial outcomes, and we see no negative spillovers to our proxy for owning a home, to home ownership, which is having a mortgage, or effects on delinquency or default on other types of debt. Okay, so sort of similar to that first set of projects I told you about, here's another setting where a particular group of undergraduates appear to benefit when they get access to additional student loans. We actually look at grad students as well in a follow-on project. And unless you think that I am sort of rah-rah, student loans are good for everybody, here we get a very different story, okay? When graduate students got access to additional federal student loans, there was no effect on whether they enrolled, where they enrolled, whether they completed, what type of degree they completed. Really, the biggest response we see is that they substituted away from private loans in favor of federal loans. Okay, and so I think here it's just a very different setting where grad students who have access to federal loans, many of them also have access to private loans. Whereas undergrads, because they have no or very little credit history, are really shut out of the private loan market and have to rely on federal student loans if their savings and grants and earnings from employment aren't sufficient to finance college. So is this really a story of student loan debt being good? I think there's a bit of nuance here that I'd like to talk about. And I'll talk about the other papers that exist that are looking at a similar set of questions. Okay. These papers look at what happens when college tuition goes up. Okay. When schools charge more, what happens when, as a result, students borrow more? Okay. And here we get a very different story. So we find, or these researchers find, actually home ownership significantly falls, grad school enrollment significantly falls, and these borrowers are less likely to become entrepreneurs and start their own business. Okay, so when student loan debt goes up because prices go up, we get this array of negative consequences, which are generally the ones that we see talked about in the media and among advocates when the student debt crisis is discussed. Okay, and why is this? I think the answer is these are two different things. So when you provide access or when you increase access, this has two effects. It increases short-run liquidity. Okay, so students have more resources available. Maybe they can pursue a major that requires additional classes that would cost more. Or maybe they can work less while they're in school so they can devote more time to studying. Okay, and so here is where we see sort of the positive effects I talked about in the previous slide. In the long run, they have more debt, which could be negative. It could mean they're more likely to be delinquent and default. But in fact, what we find in these studies is that these two, sort of the positive effect and the negative effect, kind of balance out. And on net, for these groups of borrowers, for community college students and four-year public students, additional loan debt when they gain this access has beneficial effects in the long run. On the other hand, when students borrow more because prices go up, this just increases longer run debt. It's not providing them more money in their pocket, right? Because that money is just going to pay the tuition. And so we don't have these positive shorter run effects that offset the longer run negative effects of having more debt. Okay. I think the broader story here, which is something I'm going to talk about in the class I teach in the next quarter, is, you know, student loans are a type of financing for college. And in the short run, they're no different than something like a grant that doesn't have to be repaid. In both cases, sort of access provides additional resources that allow students to make good investments, spend less time working, more time in school. It's really in the long run where there's a big difference. And whether or not sort of the short run effect outweighs the long run effect is really coming down to why student loans are increasing. Okay, is this really students are constrained, they need more resources, and this is a valuable way for them to get resources, or is it because prices are going up and students need to borrow more? So I think sort of there's a more nuanced story here, which is about higher education as a whole and where students go to school, how much they pay, what they study, and whether they complete. And all of these factors contribute to whether or not students are ultimately successful. Student loans are one piece of that, but they are not the only piece. And so when we think about all of these different factors, there's important implications for policies like student debt relief. If this is really an issue of prices, should we be doing back-end student loan forgiveness, or are there other policies that can achieve these goals? I'm not going to talk about that today. That's a huge topic of conversation, but that sort of conversation is the type that we will be having in the course that I'm teaching in the coming quarter. So that's what I've got. I'm happy to take questions, or if you think of any that come up that you don't have time to ask here, I'm happy to respond to email.
First of all, thank you so much, Professor Turner, for the presentation. I have just shared a quick handful of links for folks, as some people might be typing or raising their hand. Just letting folks know who are interested in applying that our next general information session is March 6th. Other upcoming events can be visited on our page, also linked. And then if you have any questions about admissions requirements, I also want to include that link as well. And then, yeah, we'll take, I know we're a tiny bit over time, so thank you folks for staying to gain some insight from Professor Turner. We'll give a few moments for like Kimberly Herder made a comment. It was interesting and a bit alarming, which that's how data goes often. But yeah, we'll give a few moments. And again, if folks have to drop off because of time, that's completely understandable. We appreciate you joining us for this event. One question, another question from Manish came in. Do you have links that explain the last question you raised, the prices versus access as a key lever of addressing education outcomes?
I do have links, but I do not have them handy right now. And so maybe we can coordinate and I can find a way to provide those.
And you can also, yeah, if you want to email the Harris admissions at uchicago.edu, we can get that connection facilitated. Sahana has raised her hand. I'm asking her to unmute to ask a question.
Hello, can you hear me?
Yes.
Great. First of all, thank you, Professor Turner. Such a, I don't know, like Kimberly said, a little bit alarming news, I guess. I'm a recent graduate from Chicago actually last year, and I now work in DC in immigration policy. But a lot of the rhetoric that I hear, at least in the workplace, I work at a think tank, is that the taxpayer sort of burden of this immediate cancellation of federal loans, specifically around the fact that those who maybe aren't as educated, or on average, the average taxpayer's level of education is less than those people that have taken out those loans, and that sort of burden falling on those people is quote unquote unfair. That's a lot of what I hear from like my coworkers, because I work at like a libertarian think tank. They're pretty anti cancellation of loans, which I have some loans myself. It's kind of bothersome. So what would you say to people who have that sort of like taxpayer burden pushback on either loan cancellation or federal loan or student debt reform in policy?
Yeah. No, that is one of the key criticisms of large-scale student debt relief. And I think there's sort of questions about value, right? Like our values, if we were someone who ended up with student loans versus not, is this a world we'd want to be in? One in which there's forgiveness versus one in which there's not. In terms of the policy, I think there are particular groups of borrowers who either we would actually not expect them to repay, or there's sort of a public good rationale for forgiving their debt. Or essentially they were sort of the protections that should have been in place didn't protect them. Okay, for that last group, these are students that attended schools that were essentially fraudulent. Schools lied about how much it was going to cost or what graduates earned, outcomes for prior students. And there's actually an ongoing channel of debt relief for these borrowers, that the loans they took out to attend these fraudulent schools ultimately are going to be discharged, with the understanding that there should have been protections in place to ensure that this didn't happen in the first place. That sort of second group, individuals who are providing sort of a public good or service, there's a loan program called Public Service Loan Forgiveness, which historically has not worked as well, but I think in recent years it has been improved a lot. And this is debt forgiveness for borrowers who go and work in the public sector, nonprofit, or public government institution, with the idea being these are jobs that tend to pay less, but provide positive spillovers to the broader society. And so, there should be a benefit, or individuals who have student loans shouldn't be prevented from pursuing one of these jobs. And then sort of the first group is borrowers who basically it's not very costly to forgive their loans because they're never going to repay. Okay. A lot of these borrowers are going to be those that dropped out. They have small amounts of debt, but they tend to struggle the most with making payments. And so it's a combination of, these are sort of the individuals who are the least advantaged. They don't have a college degree, they don't have high earnings, and it's the cheapest to forgive their debt because over the long run, they're not going to be able to repay it. And so I think, you know, if you paint the broad strokes of forgiving everyone's debt, these arguments about sort of, do we want to benefit this group but not this group may come into play. But I think there's many segments of the student borrower population where there's really, you know, good, maybe even economic rationale for having some sort of debt relief.
All right. All right. I think we can close up today. Again, thank you, Professor Turner, so much for sharing your research and discussing this topic that I can gain is very valuable to all the attendees here. And thank everybody for attending, for spending your time with us today in whatever morning, afternoon, or evening time zone you might be in. And we will see you at our next masterclass. Will be happening at the end of March. But again, thank you, Professor Turner. Thank you, everybody else. And again, this will also be available if you need to rewatch something. About 72 hours is when we usually get the everything settled down from Zoom. So close it now. Thank you again, everybody, for joining us this evening.
Thank you so much. Great to see you all.